Hi folks, Adam Taggart from peakprosperity.com here. Hopefully you just finished watching the video we recorded today with John Hussman. This video is the second part of today's doubleheader. We also recorded an equally important conversation with Steen Jakobsen. We're incredibly lucky to have Steen, especially on such a busy day in the markets. Steen is Chief Investment Officer of Saxo Bank. His macroeconomic and political analysis are in high demand, making him a regular on media outlets like Bloomberg News and CNBC. Steen, it's wonderful to have you here today.
Having me, Adam. It's always an honor being with your crew. It's an amazing job you guys have done over the last 6 months. Congratulations.
Now, before the coronavirus emerged onto the scene, we'd had a number of discussions with you about how vulnerable the global economy and the financial markets were in general, just by being over-leveraged, overstretched, distorted in terms of pricing. Now we have the coronavirus creating the issues that Chris just talked about. What are you seeing? What has your attention right now? And I guess maybe higher level question, why were the markets and the global economy in general so vulnerable to a black swan event like this? And now that we know what that black swan event is, what do you see happening from here, and what are you watching most closely?
So I think the answer to all of your question is credit. And if we go into the helicopter for 1 second, what has transpired over the last 4 weeks is that we've had a total meltdown in global demand from, of course, the corona and the excellent work you guys have done on how it's impacting people globally. And on the supply side, of course, we had the close down of China. And if you look at Adidas, who reported this morning, their foot traffic was 12% of normal during the months of February in China. So you can understand that one thing is that you can actually not get a demand for people having foot traffic in retailers or going into restaurants, but you also don't have the components. On top of that sits the fact that the average company, if it's well consolidated, have a cash balance of 3 months operating costs. We are now well into, let's call it 8-9 weeks of that 12 weeks that you have in place. So now there's a desperate need for credit to facilitate it. And on top of that, we had, those two being on its own very, very significant. And I've been in this market for 30 years. I've never seen global demand and global supply at the same time break down. And then the kicker, Chris' main interest when he's not talking about Corona, of course, the energy market. You have the Saudis and the Russian at each other's throat, trying to price each other out of the marketplace, creating one of the biggest single destruction of capital you will ever see at a corporate level, but also on government levels. So it actually, put to the point that credit is 99% of all new initiative that happens in the world. All of the balance sheet expansion at the Federal Reserve, at the ECB, Bank of England, and Bank of Japan has been driven on the fact that we could always create more credit. The whole concept that is now breaking, and that was institutionalized in the UK today, MMT is now de facto the operating model in the UK. So what we're seeing here, Adam, is clearly, to me, a paradigm shift. Federal Reserve will cut 75 basis points inside the next week, meaning they are zero bound. The ability of monetary policy, the price of money to have any impact on the global economy is negligible, if not negative, in the sense that if you lower interest rate, you're actually destructing more capital than you're creating. What we'll see is lending schemes and the likes that goes directly to the non-listed and SME sectors, which are thirsting from credit. So what will need to happen over the next 1-2 weeks is that the credit tap needs to be reopened significantly, but this time protecting the size of the economy that comes from the SME. The SMEs, which, by the way, is 80% of all employment and about 50% of the total production in any country around the world. We always talk about the listed companies. We have, all trying to estimate what is Amazon worth, whatever. But the gist of it being that America is driven by small and medium enterprises. Switzerland, Denmark, everything is driven by these SMEs. They are thirsting for capital. They're being locked out of credit. And now the central bank needs to step up with something they've never really been able to do, which is to reduce the red tape in terms of initiating and getting funding from the get. I think we need a blanket support for the SME and the non-listed companies. So in other words, it starts with credit, it ends with credit, and at all times in my experience of being in the market, any credit crisis always starts with energy prices either being too high, where they become a tax on consumption, or too low when you have a capital destruction. Global demand collapsed. global supply chain collapse, and now you have energy collapse, which means that there inside the next week will be one major credit event in the corporate space and most likely in the energy space.
Interesting. So let me ask a quick question, Adam. You say, Steen, that the Fed has 75 basis points of ammo left, which is sad because at 78 basis points, I would get back on a cruise ship. Where's your personal line? Just making a joke there.
My personal story?
Yeah. It's silly to me, this idea that if they lower interest rates, they're going to affect consumer behavior, which is really, that's the ultimate thing here. I know that's been their big lever. If we just can drive this thing, they can win markets, and then somehow that feeds over. But I feel like that's just a broken lever right now.
It is. But the signal here, Chris, is the market expects 50 to get ahead of the expectation. You need to do 75. And by the way, that gives you a zero bound, which means that they are validated in looking for alternatives to the way they conduct monetary policy and their communication, which means the easy part would be to do a QE. I don't think that will happen because that's an open-ended commitment to eternity and beyond. More likely is because in Operation Twister, we see some targeted deregulation of the risk capital needed for banks to do their business on a day-to-day basis. Because remember, what is interesting is that the regulatory capital that banks have to put away today, the so-called safe cash and whatever, it's a huge portion of the total balance sheet. And one of the reasons why we had the repo debacle back in December. Imagine the market didn't have credit in December. And then with that's just the repo market. And now you have that actual businesses in your neighborhood, in your village, in my neighborhood, can't access credit. And if they can't access credit, it has a price which is 13, 14% in real terms relatively to a monetary. And that's why the lever is broken. You have a government-induced a central bank-induced steering rate of zero, effectively, but no one can exit a zero except for the banks and the rich that already have it. So we are totally stressing the social fabrics and the way we do the negative interest rate. And if I may, Chris, just use 1 minute on negative interest rate. I live in a country where you've probably seen the headline that one bank issued a negative interest rate loan. What is interesting and what your viewers need to understand is that actually today there are less mortgages being issued in Denmark than ever before. Why? Because to issue as an institution a zero coupon mortgage rate, the regulatory capital you need to put aside is so huge, about 30-40% of the actual principal, that the threshold for you, even you, a rich, smart, young, good-looking guy like you cannot pass the threshold because you need to qualify for a 4% fixed 30-year. And Chris, even I cannot qualify for that. Imagine you're a young couple or someone who needs to get into the business. So you're forcing a whole generation not to own their own property by a policy that is folded. On top of that, what happens is an interesting dynamics is that, okay, a young couple, grade 2 incomes, highly educated, can't get access to credit. So what do? They go to the rental market. At what price does the rental market price? 100% over the price of ownership, which means two things. It means that we have negative interest in being a disqualifier of actually creating velocity of money and lending demand. And secondly, we have a discrimination against young and old people because those are the two sectors of the economy that cannot get access to the credit. The only one that can borrow, and the guy, by the way, who got the negative interest rate, has so much money he didn't know what to do with it. And they're all buying property because they can rent it out 100% markup.
Yeah, the social impacts of this has been something that I've been talking about for a long time. I know you have as well, because it's not just monetary policy that's being conducted, because really central banks are redistributive organizations. They take from Peter to pay Paul, and they've been stealing from the old and the young in order to keep the whole thing going. But this was all supposed to work out, fingers double crossed. Somehow they were going to keep doing this, and then it was all going to magically work out and growth was going to return. And now the coronavirus comes along and just absolutely lays waste to those plans. Are you suggesting that they're just going to do more of the same here? Just prop up asset prices because they don't know what else to do? Or will they get more creative, do you think?
Exactly. What will happen is they will be slow. We know that. That's always how they work. They're going to be massively behind what's needed in terms of the communication and being honest. Just, even in my country, which I, will say on average has a pretty good public administration, but they are sincerely underestimating the impact on the economy and certainly on the number of ICU units needed in the process of what we see, which is a massive escalation of coronavirus cases in Denmark. But policymakers are responding, and they need a dogmatic framework to operate under. I mean, I think privately, the central bankers over the last 12 months has clearly agreed that negative interest rate and zero bound doesn't work. The problem is, as you rightly question, what is the alternative? The alternative is politically the MMT. We've seen how, sort of the mid-left of the US politics has embraced MMT. We've seen the UK government, and mind you, a Tory government, a conservative government in the UK, doing full MMT today. So I think what is next is that the handover to politics happen, not because the central banks wants to give away the responsibility and the limelight, which, by the way, as a personal note, I think they absolutely love the fact they become so central. But think about it, in a proper working constitution and a price discovery market, central bankers should be the last person you ever wanted to hear anything about. They should just be facilitating the proper sort of input to the economy. Instead, they are rock stars and they behave like rock stars. And what I find totally ironic, Chris, is that, similar to Donald Trump, to be honest, people make statements which everybody knows is wrong, but they actually, in my opinion, think because they make them, we will believe them. I mean, ECB, Lagarde said last week, the impact on Corona is far too early to tell. Well, if I was central bank governor, I would be saying and assuming the worst could happen, and I would prepare my people and my 500 PhD to do a lending program exactly as we talk about this mean. But instead, no, we deny, and then we go into panic mode. And the panic mode will be direct lending first, which is going to be very difficult because think about banking, and banking gets a lot of things wrong. One of them is like intellectual property. I mean, if you have a software company, where is your asset? You go to the bank, you want to borrow money, and they go, okay, we can lend you money, but where is your tangible asset? Well, everything is in my head or in my code. Code, we don't need. We need more brick and mortars and like. So our financial system is not even built. All the credit score that people are so proud they can do digitally exactly means that no one actually taking any decision on lending money to people because, Chris, I like you. I like what you and Adam are doing. I believe in your business. I know it's risky. Hey, okay, I lend you money at 8%, but I trust you. You report back to me every 4 weeks. No, you have to be in a box. You have to be digitalized. And by the way, all of these clearing of lending happens in the capital city of the financial market that you work in. So in other words, in the old days, if you were in Sheffield, you had a great idea. You went to the local bank. They said, the local bank saying, we will help you. We can't carry it, but we will get another set of investors from Sheffield to help you out. Today, if you go in Sheffield, you have an idea. You have to go down in London and they go, oh, these idiots up in the Midlands and Sheffield, they're never going to do anything right. Only London knows what to do. So across the board, Chris, we are just up against obstacle after obstacle to getting the price discovery going in terms of price mechanism and the markets. And for the record, I think the oil market is the only market left with any price discovery. And even better now that OPEC Plus has died, now you have a proper reflection of the total risk, which I think actually is the drop in oil, equates, in my opinion, to the worst case scenario in what you can see for the equity market overall. But no, we will not getting anything new. We will get Operation Twist. We will get QE talk. We will be commitments for longer. We will, it will be the old same thing. But the policymakers now need to decide if they like MNT or not. I'm not going to decide if they like it. I'm pretty sure they will like it because it plays to issuing of debt with no cost to inflation. But I think the super tanker, which is called inflation, that is turning. It was going to that port that was called deflation and nothing will ever change. Now it's actually been told by Central Command that they need to go to a different port, which is called inflation. It will take a long time to turn around the super tanker and get it to the different destination. But everything that will happen from now on will be inflationary because it will be the government stepping up. It will be direct lending to the industries. It will be putting money. It will be helicopter money. All that stuff is coming. So I think it actually sets up a perfect ability for your shop and my shop to talk about the fact that the proper diversification in the future is not running a 60-40 portfolio because the fixed income at zero bound has no protection for you. But what does work is what we call the 100-year portfolio. Chris Kroll has done some great work at Artemis on this. But basically, you need to be long volatility, 1-2% of your portfolio, and you need to be long commodities for the protection of your inflation risk. Because we know what the politicians do. They're going to spend money they don't have. They're going to push on the string in terms of what goes on. But it creates a great opportunity for the smart investor to diversify away from a 60-40 portfolio towards what is a proper, in my opinion, balanced portfolio going forward.
Very, very well said, Steen. And I want to just drill down on one part of that, because, of course, I do agree that printing is really the only solution here. I have questions as to whether the sclerotic, slow-moving bureaucracy of the central banks is going to figure out how to get that money into the SMEs, the small and medium-sized enterprises, because they don't have a direct mechanism. So I think they're thinking they can somehow strong-arm the banks to do that. But if I'm a banker, I'm not going to loan to some restaurant chain that has 0 foot traffic and no prospects going forward until who knows when. So I don't know how they fix that. But one of my critiques of a credit bubble, of course, in a credit cycle, and it was your great work and Saxo Bank's on the credit impulse that really got my gears turning thinking about this. But one thing I noted in 2008 was just how quickly that went over and tipped over and went down. It was in large measure because when you're in a credit bubble, unlike an inflationary boom time, business cycle, CFOs can decide tonight at 8:30 that they're not buying any more shares back, and you have this instant loss of support for the market. And you have all of these balance sheets that, from my data, what I'm looking at, they basically look like mini leverage buyouts, balance sheet by balance sheet, where debt was swapped for equity, right? They borrowed money and they bought their stock back. So could you talk to that? And is that a fair conclusion that maybe that could be almost like turning a light switch moment, and what the impact might be?
I think it's slowly happening. I don't think the U.S. administration has been constructive in terms of preparing the companies, but I think day by day we now see companies doing exactly that. I think your point on the switch on the buybacks is very, very critical, because we know in 2019, most of the actual return that came in the S&P 500, I think about 100% of it came from buyback programs overall, and then particularly in the FANGs names. But in terms of what goes on, I think it's important. So how do we solve this? Because we can be critical. We have the Swedish bank model. None of apart from you and me, probably no one remembers. But what happened was that the Swedish bank system became such a bad place that they did an amortization fund where you took all of the bad lending into a fund and you amortized it over 50 years. Why is that relevant? Because exactly as you say, Chris, we do know it doesn't work with the SME and listed company lending, because Bank of England did it just after 2008, 2009. They were very visionary. They created this system to work, but the surprise for them and the overall market was that there was no uptake. Why wasn't there any uptake? Because of the red tape that I talked about earlier. So what needs to happen is a blanket guarantee that if you are small and medium-sized enterprises, you don't fill in a digital form, whatever. You fill in, I have this need, this is my balance sheet, this is how it looks, and then you get the money wired across immediately. That money then ultimately, if it becomes a decaying or negative interest rate, a negative performance asset, get put into a bigger fund that is amortized over 50 years. In that way, we can deal in an ordered way of doing this. And it will put money in the pocket of not what we did in the last crisis, which was the people with access to credit and the banks and the system, but it put people into the 80% of the US economy, 80% of my economy that really needs the money. But we need to cut the rate tape. We need to create, as you say with your question, a direct link. The only direct link you can create is not using the bank, but forcing the bank to say, take the loan, we will deal with the ramification of amortizing that over the next 50 years. And Chris, don't forget, we always have this, you can lose a lot of money, but do you know any local business people who start the day by wanting to close the business? I mean, all these people want to pay money back. If you look at the microfinance of Africa, it's actually one of the greatest human experiment positively that you ever seen. They have a payback rate of like 98% or something. Chris, this will solve itself, but it will not be solved if we stick to the old formula, digital, non-direct. We need a cash sort of payout that goes to extend. Even TAP didn't work except for the big companies, right? You had the local governments could access infrastructure funds. No one took it up because no one wanted to have the tax conversation with their local constituents. So Blanco, and then amortize like in a Swedish bank model over the next 50 years. If it goes to SMEs, I'm buying that bond when they get issued for sure, Jim, Chris.
Great. Adam, I'll turn it back to you now.
Great. Steen, just a question for you. I think a lot of people who've been watching from the sidelines have been a bit surprised at the lack of speed with which the Fed and the other central banks have stepped into this most recent market drop. I mean, they seem to have been intervening at the drop of a hat, if the market was down a couple of points, it seemed at times over the past several years. Why do you suppose that we haven't seen them bring out their bazookas yet? Is it because they're planning, something huge like you're talking about, or are they deliberately letting this play out a little bit to take some air out of the system? Or I'm just curious, are you puzzled as well that we haven't seen a big response from them yet?
Not if you read Paul Volcker's book, Keeping at It. I mean, you do know that central bankers are not in the business of having foresight. They are in the business of having political pressure at all times. And central banks is just unable because they created this communication policy, which is the biggest lies ever. I mean, they think because they communicate that I will buy whatever they tell them. What happens in practice, as we've seen with the rate cut last week and the 75 basis point that we are most likely getting, the market forces the hand of the Federal Reserve. Federal Reserve is not steering anything. They're barely, able to decide what is going to be at breakfast in the canteen anymore because the policy of communication doesn't work. I mean, I can't talk to my wife. How should they be able to talk to the market, right? So this communication policy paint them into a corner. The policy doesn't make sense. They know it doesn't make sense, but they don't want to admit it because losing, Adam, they have 500 PSD that are all wrong. I mean, the whole building at the Federal Reserve in Washington is wrong about all the research they ever done because it's an post analysis of what goes on. When you deal in real time, if you're trading the markets like we are, you have to deal with the change to the policy response. The policy response is inadequate, it's not communicated well, and it needs a total different tool where it is to go to the center of this, putting money in entrepreneurs, putting money into the small moms and pop shops on the corner, and making sure that they, for the first time, have the benefit of being in focus.
All right. So clearly, you're saying the Fed, like lots of old generals, is fighting the last war, fighting the wrong war, not the war that's being waged right now. I'm just curious, as you talk about the deployment of capital to Main Street businesses, do you have a sense of how the mechanism for how that's going to be delivered? Is that policy that comes from the Fed? Is it policy that comes from the administration? How exactly does that happen?
I think the most likely it comes from the Federal Reserve in terms of the money being issued. But you have to remember, and it's a very good question because people forget the only place in the world that actually create money is the banking system. It's not the Federal Reserve that prints the money. It is the fact that a local bank in Iowa can go to the Federal Reserve window and deposit $100 and get $1,000 back in lending ability. So number one, we know the rule will be that there will be Federal Reserve will be the service provider. The local banks will be who provides. And by the way, that's a lot of way like the Agriculture Bank of U.S. in the farming industry in the U.S. works. It's actually based on guarantees. I mean, I'm sure the local farmer in Texas local banker in Texas claims that he's the guy who's providing all the funding to the farming industry in Texas. It's not actually. It's the Agricultural Bank of the U.S. that guarantees it. And that is exactly the kind of schemes we need back in and operating. You can use the agriculture system that you have in place in the U.S. to lever that in terms of other businesses in the U.S. But it's always going to be the banking system. On top of that, of course, someone needs to issue the guarantee. That issue of guarantee needs to be against the tax receipts, unfortunately, which is you and Chris's. And so the government will need to be able to guarantee this. But this is, again, isn't it MMT really, Adam? I mean, you just continue to create, this time you're not putting up the money as government, but you're guaranteed against the future tax receipt. And then you go to the Federal Reserve, they are the service provider, and then the local banks go in and do it to the similar model that you have in the agricultural sector in the US.
Yeah, it's amazing that MMT, it's amazing how quickly it's gone from sort of a trial balloon. I mean, I think most people, if you've even heard about it, hadn't heard about MMT, more than a year ago, and now here we are, looking like we might actually see it in practice at a grand scale. All right, well, look, moving on. This is a great topic for switching to sort of the practical side of the discussion, which is, what do we see coming next, and what should concerned investors do about it? Now, Steen, you've just made a great case for what's coming next in terms of the form of this MMT wave that's going to hopefully keep a lot of small businesses around the world from going under. Because as Chris mentioned, I do think without some sort of intervention by the government, this would be an extinction level event for lots of big players in a lot of industries, but certainly for lots of little players. You have a coronavirus come to your town and everybody self-quarantines for a month. There's a lot of retailers that are just not going to be able to withstand being shut down for that long. So from your perch, Sven, and then Chris, I want to ask you the same question. Sorry, from your perch, Steen, given looking at what happens from here, let's talk about the markets first. Do you see the markets stabilizing as these rescue efforts begin to be deployed, or do you think we have a substantial amount further to fall here, or do you see something else playing out in the markets? But I guess, for an investor that's just watched 20% of their portfolio vaporize, should they brace for more, or should they feel that the worst is over at this point?
So there are, many ways that you can try to extrapolate what will happen to the market, and very few that really works. But being a primitive guy with a low IQ, what I tend to do is to use the energy market, which again, as I said to Chris, is the only market, to my opinion, that has a price discovery. So I'm saying, if you take the total drop in WTI crude and approximate that to be the same risk that the equity market has, then we have another 15% of risk in worst case. I'm now only talking about the worst case. If we talks about in terms of valuation, we're getting towards a fair valuation for some of the bigger companies and better quality companies. But we in a classic crisis, and unfortunately I'm old enough to have been through a few of them, we need to go to cheapness before we actually need to buy. So I think the direct answer to your question is somewhere between 5 and 15%. But the way the market trades the volatility, how the VIX volatility keeps being high, how we have disintermediation in terms of the credit from bank to bank, but also in the marketplace. On a normal day in the S&P mini futures, there will be 5,000 by 5,000 contracts. Now you barely have 2 or 3 by 5 contracts. So the liquidity, which is another phenomenon we've created over the last 20 years, all this digitization is fine in principle, but Adam, there are no end takers of risk. There are no entry risk. My platform, Saxo Bank's platform, is based on prices from everybody else. And then we changed it by a small tilt, 1 pip to one side and 1 pip to the other side. But at the end of the day, we also want to get rid of the risk if you give me any. So, the discontinued pricing is the worst nightmare in option theory, but also in market practice. The fact that you can buy whatever you want when you get through the front door, but when you're going to get out again, there'll be a long line of people who also want to be part of it. You remember the fat fingers in the ETFs that happened was a couple of years ago? That is your worst case. That is the discontinuation of prices. But companies don't go bankrupt because people are stupid or not able to function well, or bad management. That's not why people go bankrupt. They go bankrupt because they have no liquidity. Liquidity in the marketplace, liquidity in terms of credit. So, your viewers want to be observing the credit spreads, which, by the way, have risen the most that I've seen since the 92 crisis and the 2000 crisis. The speed at which, the ferocity at which the credit space has expanded, i.e. the credit has become poor quality, it's just amazing to me. And that's mind-blowing. And that's what I keep an eye on almost a minute-by-minute basis.
Great. Which follow those? What credit spreads do you watch most closely?
Yeah, so if you want a sort of liquid way of doing it, you can observe it through HYG, HIC, and Jiang GNK, which are two very, very well capitalized bond spread. Or you do classically crossovers, or you follow individual credit that are at risk. You can look at American Airlines bonds right now. They're hit, unfortunately by the wire, the global demand. So you can find single names to play with. But the classic way, if you go to Yahoo Finance or whatever website people use the HYG or the GNK, junk, and those two trades, the same way that credit spread trade. If JNK drops, it means that the credit spread is widening. So that's a good way to monitor it.
Okay, great. And Chris, as you look sort of through your crystal ball here, what do you see as the most likely sort of macro factors happening in the markets from here? To Steen's point, do you feel that there's still further to fall, and this is not the time to be looking for jumping into the markets and feeling like things might be on sale because of the recent 20% drop? And is it time to sort of hunker down and wait for better value, or do you think that there might be argument to move today?
Well, I'm a really good long-term trader. I'm a really poor short-term trader. I have no idea where things are going 1 minute to the next. And I think that it's a variety of things that make it's always difficult, of course, but a variety of things make it even more difficult. Steen was just talking about the lack of liquidity. It's something that you and I have explored a lot, and talking with people like Joe Saluzzi and the other market structure people, saying that, hey, we have all these computers and algorithms that are out there running. They're pretty remorseless. They're very good at parsing risk and stealing pennies from trades. But if they want to, they also disappear in a heartbeat, which is why we've had all these flash crashes and things like that. The big one in May of 2010, but mini flash crashes or even mega flash crashes in the treasury market, even something as large as the US dollar market at various times. So the market structure is something, that's one risk bucket that concerns me. There's another one I don't really understand yet, which maybe Steen could help us with, which is there are all these ETFs that are now outnumber the actual number of issued shares that they're supposed to be sitting on top of. And so those have, some of them are constructed well. Some of them may have very sort of self-reinforcing liquidity problems in them where it could actually be a case of selling, begetting, selling, begetting, selling, which is a risk that I don't know how to get my arms around yet at this point in time. And the thing that gets me the most, though, is the systemic effect of all of this. So the thing I'm trying to, when I have a few moments, what I'm chasing down, and we have to do this at the macro level, I'm looking at stuff like air pollution levels over China and global shipping, just how many boats are in the water without even being able to analyze what's on them. And from that standpoint, we've just seen a massive, massive disruption of supply chains, which is not just a complicated thing. So Apple has a complicated supply chain. A collection of companies that Apple relies on has a complex supply chain, which means it kind of defies prediction. So, you know, just to take an example, Apple has, say, a Foxconn plant somewhere in the Wuhan district, and that plant may have 1,000 sub-suppliers out there, any one of which, if it's supplying a single critical element, any one of which, if it goes out of business and can't supply, I don't know, the chipset for the camera, you can't make phones anymore. And so trying to figure out all those second order derivatives, which are, you know, beyond that one Foxconn plant has a bunch of, you know, inventory that it can draw through. But as soon as it's out, the question becomes, where does that come from? And do they have single or sole source, you know, or multiple source providing for that? And then that person, if that factory's out, who's making that chipset for the camera, then what are their needs and where does that, it's just, it's really I don't know how to begin predicting that. So I've talked to a lot of supply chains people who are down at that level, and they've said that the point of failures in this system are very easy to come by. You only need one factory somewhere in a critical bottleneck to break down, and your whole supply chain basically breaks down. So I don't know how to get our hands around that at this point in time. I think the market is still not yet pricing in the full risk of that. Whether that comes to be true or not, you know, whether we have a more substantial supply chain breakdown, you know, the ones that are most concerning are things like the active pharmaceutical ingredients or the precursors that India needs that they're not getting from China and that they've just stopped exporting or limited exports on. So those sorts of supply chain issues, I'm having a real hard time trying to figure it out. But the individual dots that I'm getting from supply chain managers, sort of you back up and the mosaic pattern starts to reveal itself, and it says, this is a really, really profound risk. And, you know, in my world, you know me, I prefer to control risk as much as possible. So under circumstances like that, I think it's prudent, it's wise for people to consider having chips off the table. As always, we advise, you know, get your buy list ready because there will be cheap prices again at some point. I agree with Steen, it's not yet. We got to do a little overshoot first. And as well, there's nothing wrong with just watching for another month or so, because this coronavirus, we're not past it. We're actually still before the peak of it, which we're anticipating in maybe the mid-May to early June timeframe, depending on how it unfolds. So I guess my advice there, is such as it is you know, be as cautious as possible, because there's a lot here we don't understand yet. And Steen, you know, do you have you know, is there any better way to be getting a handle on what's happening on the supply chains?
No, I think, you know, the way we monitor it is through creating, we create a basket, credit basket, and anyone who wants to see can go to Saxo's research, which is on analysis of Saxo. So we are taking names that are at risk. We have American Airlines, and we are not picking on American Airlines, but they just have a horrendous traffic drop. We have a number of other names that are in the traffic. So I think you're absolutely right. And I said day one, and you know, I know nothing about Corona. I don't want to be involved in predicting anything on Corona. But as an economist and someone who's done this market for 30 years, I know the fallout from that can be and is measurable. And it is measurable. You know, we saw, as I said earlier, we saw Adidas today guide 1 billion euros lower in top line growth for first quarter this morning with a margin of 50%. That's 500 million to the bottom line. This is a well-consolidated company having basic issues. Imagine if you are stretched, your product cycle is late, it's early, you're lagging. I know I advise a number of companies in the shipping industry. There's actually some routes right now where you get paid to get your freight moved simply because the logistic of the shipping lanes is such that it's cheaper for the ship owner to actually pay someone to put tonnage on the ship to get the ship to a port that has better ability to actually move that ship again. So Chris, this is not even started. I mean, if you say the peak in terms of impact from the coronavirus is in May, which is honestly a bit shocking for me that it will take that long, but just shows my ignorance, then I'm saying that the real economic impact is Q4 exactly into the US election. And that, from an outside perspective, non-American, concerns me a lot, because I know one thing about the White House is, and that is they would do absolutely anything to re-engineer some kind of story that can get them reelected. And I think that's dangerous, because right now it should be about protecting Americans in the short term, but in the long term, regenerating that great spirit of entrepreneurship, the fairness that always been prevalent in the U.S. economy, and close that divide. It doesn't really matter whether you are Sanders or Trump. I think America has shown that it has resilience to do this, but the resilience comes from one common platform. That common platform has to be that America has to be productive. It has to be doing the right thing at the right time. It's not about an election campaign. It's not about promises on the left, right, and minorities. It's getting together and creating a platform. And I think, if I may, Chris, allow me 2 minutes on that. Since World War II, we have lacked a platform. After World War II, we all agreed, fighting wars and whatever was a good platform. Then we had, in Europe, we had the social democratic, the welfare state. But now we have nothing in common. And if anything, we have the rural areas versus the cities. We definitely have the banking system versus the governments. We have, politically, better than me, you have, left, right, center. I can't tell the difference. They all want to just give things they can't afford. We don't have a common denominator anymore. And my hope has been that climate became that, because climate goes across age gaps. It goes against political persuasion, or at least it should. And it's totally, thinking about it, if we were looking for climate solution, not green for the sake of green, but just climate solution. Do you know what's beautiful about that? That all the solution to the climate sits in actually doing a product, or going into nature, or doing something that is physical. The exact antithesis of how we created wealth and businesses. And let me close on the final thing, because I think it has allocation implication. If you look at the 10 most powerful companies 20 years ago, energy was 80%. The most powerful companies today is computer companies and database one. So what is the lesson here? So 20 years ago, extracting fossil energy out of the ground was the most viable and most valuable business. Now extracting value out of data is the most valuable business. In 20 years from now, and I'm very hopeful here, Chris, I think extracting solution to the climate will be what is the game changer. So to some extent, and I hate to say that, I've always believed that the only way society and paradigm shifts is through the breakdown. And I think we are, in baseball analogy, and I know everybody hates sports metaphors, but I think we're in the mid sort of fifth inning before we get into the real sort of excitement in the game. But I'm very hopeful that this crisis will provide a counter swing and towards a platform that is more unified, because to me, climate is the solution. And mind you, I have no idea whether it's humans created or not. I don't care. What nature tells me when I tour around the world, and I spent at least 110 days a year around the world, is that nature tells us with a huge event risk that, the cost of ignoring this is just too high. So for businesses, for consumers, for you and I as an individual, we need to be part of that solution. We need to embrace it. Whether it's man's created or not, whether it's been there before, I don't care. The cost right now is actually detrimental to the structure, which is the fourth component we haven't touched. That climate just dictates that there will be more spending. So Corona spending in the short term will be the new sort of buzzword. I mean, the UK budget day had Corona in it, and not as in terms of the virus, but in terms of the wording. And I think in the future, it will be climate, Corona, and infrastructure that becomes the buzzwords, and that's where the money is, and the real fundamental value.
Yeah, I agree. And Adam and I have talked about this. One thing that the virus is doing is it's exposing the value system in the United States. And a lot of people are looking at that and seeing it's wanting, right? because we've clearly prioritized saving the economy or the stock market's valuations over protecting human life at the outset, which is going to be a self-defeating loop, because if you don't do this, this ruins your economy anyway. So you have very tricky balancing act, and we haven't gotten the balance even remotely right yet from my perspective. But here in the United States, we spend more on healthcare than any other nation, 3.8 trillion at last. Let's call it 4 trillion. It's not unthinkable to me the corona is going to cause a 25% boost in that, because the average stay for somebody who does get this and is critical is 3 weeks in the ICU. In the United States, that's $1 million bill or something close to that. So the question becomes, who's going to foot that $1 trillion? I think it's going to have to be the government. I think they're going to have to eventually buckle under. They're going to have to spend that. The central bank's going to have to monetize that, which is why I think, again, I don't know how to, I can't prevent or protect against any of that, but I think hard assets, however you measure those, commodities, we'll call it, is a great way to at least avoid some of that. Because I don't think they have anything to do but to print. But unfortunately, I think they're going to be slow about it. I think they're going to do it grudgingly. I think they're going to political grandstand, because there's such a divide between the left and the right, and they hate each other so much right now. That's going to cost time. We can't afford time right now. This is a fast-moving thing. Small and medium enterprises can't wait 2 months while you work out your political differences before you knuckle under. So that's what I'm concerned about, is just the degree of polarization at a very awkward time in history, which is going to take time for them to figure out how to work together again. And it's in that gap, I think, that if, for everybody listening, my advice has been, particularly if you're a single paycheck earner, is you just gotta reel it in. Take all your discretionary and just throw it out the window if you can. The extra cell phone plans, whatever you need to do to begin to hunker down, because you got to survive until they figure out, they being the fiscal and monetary authorities, until they devise a plan for finding out how to get money to Main Street this time, which I think they're going to have to do. That's how I see it right now. Of course, that could change, but I don't see any other way through this. But I think we're going to do it slowly and possibly poorly at first in the United States for political reasons, unfortunately.
Well, gentlemen, I hate to do this, but we are at the end of our time here. It has been a phenomenal discussion. Chris, Steen, John, thank you guys for taking all the time today, especially on another busy day in the markets. Quick glance shows that the S&P is down over 4% again today. So the volatility continues. All right, so for people that have been following the discussion here closely and are inspired to continue following things or take action from this, you guys gave a number of recommendations. I'd just love to ask each one of you speakers if there's any resources on your end that you'd like to direct people to. Steen, let's start with you. Do you have any resources there at Saxo Bank? I think you mentioned one or two already that you think concerned or interested viewers would benefit from taking a look at.
Yeah, so all of our research is to be found on analysis.saxo. We have right now a bounce back basket that we want to look at, which is basically a product where we are looking at quality names that has fallen the most, which we expect to be ones that pick up. So Chris was talking about indication of the market turnaround. If those kind of names start to reverse, so feel free to go there. And my whole team and myself are prolific on the Twitter. Saxo Strats, SAXO STRATS is where we can be found, and you can find individual names. And again, we don't pretend to know anything about what it was transparent in the market, but we at least try to be, even keeled and having a sense of skepticism towards what we have fed in terms of communication. And at all times, we know we are wrong more than right, but we want to create that and stir that conversation.
Fantastic, thank you. And Chris, at Peak Prosperity, we have resources both on the side of folks that are looking to maybe get some help in managing their money during these volatile times, as well as daily updates, keeping people abreast of the coronavirus situation. Do you just want to give a little bit of specificity on where folks should go for either of those?
Sure. If you want to be tracking really the medically what's happening and the progression of COVID across the world and the implications of that, you can find all of that at our website, of course, at peakprosperity.com. And we have a YouTube channel there as well, chrismartenson.com, spell the .dot out, and you'll find that channel there. Be sure to subscribe to it, and then be sure to remember to resubscribe, because Google has very helpfully been unsubscribing people from that channel because we often contradict what the WHO officials are saying. And somehow that's offensive to YouTube. So we'll figure that out over time. as well, you can find us at Twitter, and that's at Chris Martenson. You'll find us there, and very active on Twitter as well. And but otherwise, come by Peak Prosperity, and we've got mega threads there, which can help people. And a mega thread is organized by a big idea set. So one might be how to prepare and have your household prepared. Another might be how to remain healthy and how you can boost your immune system and steps you can take if you do have to treat at home, which doctors are increasingly saying you're going to have to do. And as well, how to handle your money and make sure it's safe and things like that. So yeah, peakprosperity.com. Almost too much information now. We're working hard to condense it and make it manageable.
Great. I'll just make a pitch here as well for our relationship with New Harbor Financial. They are the financial advisors that look through a similar lens as we do at Peak Prosperity. Right now, we're getting deluged with requests from people who are saying, I'm watching my retirement account vaporize before my eyes. I really want to get some help in getting myself a bit more protected to the volatility that's going on that Steen was talking about. And this is a relationship that we've had for over 10 years, guiding people to this financial advisor who really focuses on risk mitigation and return of capital much more than return on capital. And I'll put the URL for how you folks can schedule a completely free, no commitment consultation with them here on the screen. All right. And with that, gentlemen, again, can't thank you enough for taking the time to share this extremely important information to people in a very confusing, frightening, and fast-changing time in the markets and in the world in general. So, Steen, thank you so much for joining us, sir.
Thank you for having me.
John, thank you as well, my friend. And Chris, you want to take it home here?
Yes, thank you for listening, everybody. We're going to be providing a lot of updates as we go forward here. There's just an absolute flood of information. We're doing everything we can, including not sleeping very much, to stay on top of it. So thank you for listening. There'll be a lot more coming, and our advice is please take this seriously as you can, and trust yourself. Whatever conclusions you come to, trust yourself, do the research, figure out what makes the most sense for you, and then do that. Because of course I don't have all the right answers. I probably have barely any at all. So it's just a really fast moving situation. We're doing the best we can to bring you the information that you can use to make decisions to keep yourself and your wealth safe. So thank you for listening, and we'll be back soon.
All right. Thank you, everyone.